Good morning, everyone, and welcome to our DAT Weekly Market Update. This is our update for October 24th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, Principal Industry Analyst, and we have a very, very special guest this morning. We have John McCown, who's a foremost shipping expert. Good morning, gentlemen.
Good morning.
Morning.
So we've got quite the stalemate here as we're talking behind the scenes. John has allegiances to Alabama and LSU, I hear.
Yes, I do. Very strong allegiance to both.
Two teams that have defeated Ohio State in the national championship in the last few years, I might add. I remember when Ted Ginn returned that touchdown on the opening drive and then didn't score again the entire game. That was pretty sad.
Both excellent games. I love the way they ended.
Yeah, I'm sure. I'm sure. Well, I think we can all agree on one thing, and it's that Michigan is nothing but a group of filthy cheaters, and I think that's all we really need to say about that. So we're very thankful to have you on this morning, John. Do you want to give our listeners kind of a brief introduction and kind of your story?
Sure, I'd be pleased to. Pleased to be here. I've been in the freight business really for over 4 decades, mostly as an operator, but also as an investor. After business school, I joined what was then McLean Industries, ended up working for about 20 years with Malcolm McLean, who invented container shipping. And then we started a new carrier, Trailer Bridge, which was really the first carrier in the world to move freight in 48s and 53s to Puerto Rico. And then after that, I was at a hedge fund where I invested in transport companies, particularly shipping companies. And more recently, I'm a senior fellow with the Center for Maritime Strategy. I write a lot, involved in projects kind of in the sector. And I put out a report kind of on container volume coming into the U.S. So I'm staying busy in the sector and, still love it.
That's awesome. So thank you for joining us. We'll bring you back here in a few minutes. We're going to hustle through our procedural business here so that we can have a healthy conversation towards the end. So again, thanks for joining us. Sit tight. We'll be back in just a moment. So there's obviously a lot going on since we last spent some time with y'all on the video last week. Most notably, there was a large digital broker that went out of business. I think that's been dominating the news headlines, although that's not something we have listed here as a key point, but I think that goes without saying that it's a major news story. Spot rates flat to slightly up for the second week in a row. Housing starts to rebound, but sentiment is just not good in the building sector at all. Class 8 new truck orders up 13% month over month as capacity exits the industry, resulting in truck auction inventory surging in September. That's the highest since May of 2020. The UAW strike is entering the 6th week. We've got uncertainty in the Middle East. And then I think a big thing here that Dean put in our list that isn't to be ignored is student loans picking back up. So there's a lot to keep an eye on this week. And to guide us through all of that, I will turn it over to Dean for our market update. Dean?
And the load-to-truck ratio, just before we get going, folks, the long-form version of the report will be published this evening. So you can go to dat.com/market update. We'll do a brief market update today, starting off with the load-to-truck ratio in dry van. Pretty flat last week, about half the volume on the spot market we're seeing in dry van compared to this time last year. Load-to-truck ratio is sitting at about 2.0 this week. In refrigerated, flat for the second week, also still just over half about the volume we'd normally see this time of the year compared to last year. Load-to-truck ratio primarily flat at 2.78. And in flatbed, much the same story. Load posts were flat this week. All of that data in the charts will be in the weekly update published this evening. Quick look at some of the regions on our market condition index. Capacity was tight in the Pacific, Northwest, and Mountain Prairie regions, as it is this time every year. Fall produce season is certainly underway up there. Rates averaging about $1.59 per mile outbound. That's up 3 cents a mile. And remember, folks, these are line haul rates excluding fuel. We expect rates in that part of the country to increase about 24 cents a mile, maybe as high as 30 cents a mile before Christmas. Again, Christmas tree shipping season and fall produce will drive rates up, right up until the week before Christmas there. Los Angeles and Ontario markets rates up 2 cents a mile to $1.84. They've been dropping for the last few weeks. And having a look at refrigerated, of course, the big story is the pumpkin capital of the world as we head into Halloween next week. Morton, Illinois is the sort of a self-appointed pumpkin capital. Our volume of load posts in the refrigerated category up 12% last week. Outbound spot rates are starting to climb as they do this time each year, up 3 cents a mile to $2.89 after being flat for the last couple of weeks. A lot of volume is moving from Morton, Illinois to Lakeland, Florida. Rates are averaging $2.90 a mile, while loads further south to Miami are the highest in 12 months at $2.83. A lot of capacity tightness along the southern border, all the way from McAllen to Yuma, Arizona, particularly in Nogales. A lot of our produce volumes this time of the year are coming across from Sonora into Arizona via the Nogales crossing. Load posts are up about 37% last week. And in flatbed, capacity tightened last week for flatbed carriers, rates up 3 cents a mile to $2.06. In the largest flatbed market in the state, in Fresno, load posts are up 18%. Rates up 3 cents a mile to $2.08. And in the other part of the country, not big freight markets, just north of where John is in New York State, across the Finger Lakes region, flatbed capacity was very tight last week. Load posts up 66% week over week. Outbound spot rates across the region surged. They were up 75 cents a mile. Regional average was about $3.22 per mile after dropping for the prior 3 weeks. And wrapping up our market update with our look at year-over-year spot rates, dry van line haul spot rates mostly flat for the last 3 weeks at about $1.57, still 19 cents a mile lower than this time last year. And as you can see from the chart, sitting slightly higher than 2019 at about 5 cents a mile above that low water mark. In refrigerated, at just over $1.89 per mile, reefer line haul spot rates are about 20 cents a mile lower than last year, also sitting around 5 to 7 cents higher than in 2019. And lastly, in flatbed, line haul rates were flat for the third week last week, averaging about $1.88 per mile, still 18 cents a mile lower than last year and almost identical to this time in 2019. And with that, it's over to Ken for the short-term forecast.
Thank you, Dean. So we kind of rushed through these yesterday because we had a different order, so we'll take some time today. We always start with dry van. The blue line is the historical data going back several months to give an idea of context. It's the long haul dry van full truckload, excluding fuel. And then we have 4 forecast models. So we have our ratecast model in green. That's the flagship model that's in all of our products. We've got the red line, which is a short-term model, which more heavily weights near-time data. And then you have the yellow and the gray, which are blends of the two different extremes, if you will. They blend short and long-term data in varying levels. So what you see here is there's some disagreement, but not nearly as prevalent as it was a few weeks ago. I think the seasonality, as we start to inch closer and closer to Halloween, which is next week, and then start setting our sights on Thanksgiving and Black Friday, pretty much seasonality is going to start to dominate what the models are picking up. So I think you'll start to see these forecasts. We'll see if I'm right or not, but over the next couple of weeks, I would suspect that these forecasts start to really coalesce and start pointing up and to the right as we head into the busy retail holiday shopping season. Pretty much what you're going to see next as I flip to reefer. This is the picture I think you'll start to see as we get into the next few weeks, with forecasts starting to tip upwards and also agree a lot more. So 2 distinct things, but I think important to keep an eye on. And then we get to our most aligned forecast, which is just sort of not very interesting at the moment because it's just kind of flat. But all 4 forecast models for flatbed are generally aligned, that we're at a market bottom and staying there for at least the next 35 days. So those are our forecasts. I imagine in the next couple of weeks, at least before we get too close to the peak, we will update our long-term forecasts, and we will, like I said, in the next couple of weeks, bring those on the show. So with that, we are going to move on to Dean for our question of the week.
Ask you, but let's start with one of the ones that have dominated the news media in the last probably 18 months. We've seen labour instability and port congestion on the West Coast lead to a shift in imports, particularly to the Gulf Coast for a lot of break bulk and steel. But and the East Coast, of course, picked up a lot of that volume. Some of the bigger ports there have invested a lot of money in infrastructure. But we're starting to see cargo coming back to the West Coast. And I guess the question for you is, do you think we're headed back to a more normal coastal split in import volume?
Yeah, I think it is. Some of it is shifting back. I haven't. I'm about to put out a report on September, and I think overall, looking at kind of year over year, it was flat this September versus last, which is a real difference because it's been a real roller coaster. And the West Coast was up, as I recall, about 16% year over year. East Coast was down about 13 or 14%. So we're seeing some of that come back. What is interesting, and yeah, that clearly the labor situation and the congestion situation led to a lot of shifting, and some of that will come back. I guess my own view is that there's not all of it's going to come back, and there's some economic reasons and even congestion reasons. Eventually, the whole emissions issue, and what I'm speaking of really is the freight that comes over the West Coast that heads to largely eastern points. And that's still a lot of freight. Clearly, that has the advantage of transit time. But when you kind of look at it, drill down in economic and emissions, there's a certain shift that's been going on actually for a while, subtle shift, but from West Coast to East Coast. And I think we'll see that continue. There will be a bounce back. I don't think it'll be necessarily back to where it was, but the data is showing, I think, in the West Coast, that split in September was as high as it's been in the last 2.5 years. So you are seeing some of that shift back.
John, can you talk a little bit about the shift in where the imports come from, right? So if you think about regional Northeast Asia versus Southeast Asia, on the data we get from IHS Market, we see that Northeast Asia volumes are down, but Southeast Asian volumes are up. And of course, they're much lower in terms of total TEU volume. But can you talk about the economics of, going from Northeast Asia to Los Angeles and then the Panama Canal versus the opposite direction from Southeast Asia via the Suez Canal to the East Coast?
Well, that's clearly a shift that is favoring kind of the all-water route, particularly when you think of Cambodia and Vietnam, to a less extent Thailand, have had pretty massive increases in their exports to the U.S. A lot of that, frankly, is shifting of production, to avoid the tariffs. But when you get into that area and you just kind of look at the map, and if you have freight, say, going to the New York area, all of a sudden the Suez Canal is a shorter distance. So that's one of the factors that is at play. And of course, the other one that's been at play for a long time and it kind of pushed up that shift was the expansion of the Panama Canal in 2017, where you could have 4 times as big ships. And so that gives kind of the economic advantage. So both of those are at work. Yes.
When we saw recently, maybe it was probably about 8 or 9 months ago, I think that one of the large Class 1 railroads started a service or planned to start a service from Houston to Fort Worth. It's one of the lanes that we've seen a tremendous growth in truckload volume on and the expansion of that. So similarly to the East Coast and the sort of the all-water route, do you think volumes around the Gulf Coast will also be sustained because of the deepening of the port in Houston and the more rubber-tied gantry cranes they've installed?
I definitely do. No port has really performed probably as well as Houston over the last 3 years, and it's obviously benefited from the COVID shift. And Houston, in a way, is the first port you can get to, even though the Gulf Coast has a little bit of a disadvantage kind of tucked in where it is. But Houston has benefited immensely from that. The other thing that's kind of a little bit of a subtle a subtle point that helps Houston is Houston has a good amount of export cargo also that petrochemical products, and everything else equal, the more balanced a port is, the better it is economically for the shipping line and indirectly for the customers. The container shipping business, it's thought of as a system, and many of the big ports are highly imbalanced where, the imports are, sometimes 3 or 4 times as much going out. And so that cost has to be borne by somebody. Houston is one of the much more balanced ports, and so it's benefiting from that. Other Gulf Coast ports, my hometown of Mobile is also very nicely situated, just geographically, with room to expand, and so both of those ports, will continue to benefit. Again, that's that macro shift, kind of eastward. If you simply were to do a algorithm of moving freight to, freight and containers in the end goes to where people are. And if you did an algorithm kind of on your water cost per mile and your rail double stack per mile and your truckload, in the end, freight would go to where the people are. And if you look at the population density of the U.S., that really translates into only about 25% of the freight coming in containers going over the West Coast, 75% East Coast and Gulf Coast. Mm-hmm. And right now, I'm not suggesting that you're going to have that mix get down to that, because there are other factors, obviously. But right now, you have roughly kind of 50% of the freight going over the West Coast. Mm-hmm. So there's still some room for that to shift. Now, again, the transit time advantage the West Coast will always have.
Mm. And moving a lot of that volume inland, of course, to Chicago, with the excess capacity on the intermodal side, the rates for shippers are certainly in their favor right now.
Correct. Well, when you mentioned that, I was just thinking when I joined the container shipping industry in the early 80s, I always remember back then, certainly Chicago was the biggest, freight center in the U.S. by a far, large percentage. And I recall seeing a figure in terms of warehouse space in Chicago versus others. You now, when you look at it, obviously all of the freight that comes in millions of containers will eventually move to other the modes for the most of it. And I think Southern California now has something on the order twice the warehouse and distribution center space that Chicago has. And all of that is really from containers, an industry that I guess up until the COVID was still kind of largely invisible to the public. And with the issues, when people say the supply chain problems, ground zero was the container shipping industry. When you had 110 ships off the coast of Southern California and the container ship wedged in the canal, everybody all of a sudden became more aware of this industry that is really a part of their day-to-day lives.
Yeah. The other data point that we sort of touch on with imports is in that Ontario Inland Empire area, and it's got to do with transloading. Do you have much insight into the amount of TEU volume that comes in from overseas that ends up being transloaded for a variety of reasons on the West Coast?
Well, it's pretty significant. It's most significant probably at the Port of Seattle, but it's big at all of them. And I guess my observation, and I've written a lot about this, it's that transloading activity, because we all know the 53 is how to move freight most efficiently domestically. And so if you're going to move freight that's in a container and it comes into Seattle and it's going across the country, it's more cost efficient to take those 3 40-foot containers, spend a couple of days and the cost to unload them and put them in 2 53s. And, that's really not the way container shipping was supposed to work. I've written recently about, what I think could be a nice initiative by somebody, and ideally, frankly, somebody like a J.B. Hunt or an Amazon, to start a new service from China, moving freight in 53s. So you take out that entire step. So the transloading activity is quite significant, but it plays a big part in the congestion. And I find myself thinking that there's a niche market for taking that process out of the out. I mean, J.B. Hunt is already effectively involved in that market with the thousands of domestic containers moving over the West Coast to much of the country. So yeah, transloading is a big activity, and in many respects is perhaps an unnecessary activity.
So the extension of that would be that we'd have to redesign the configuration of ships, to have a bigger bay. But then did the spreaders on the gantry cranes automatically go to 53 anyway, or is that a whole new set of infrastructure on the loading point that we'd have to think about?
I think the modern container cranes can handle that. When the service that I was involved in co-founding, Cradle Bridge, moved just 53s, we had a rather unique, and at the time there weren't cranes that could handle 53s, but we had a patented system where we accessed the flat deck barge with the Kalmar reach stacker, which really had the same productivity as a container crane. But yes, you could adapt the cranes to work for that. And again, that would only work, in a niche market, really only the China to U.S. market. But China's where they make all the 53s to begin with. And China is something on the order, the last data I looked at, a little over 40% of the inbound containers into the U.S. come from China.
Yeah, I was just looking at some data while you were chatting. I noticed that talking about the balance, Savannah, for example, I think in September was number 5, I think, on the import list for TEU, but number 1 for exports. So it's one of those markets that's incredibly well balanced. We see a lot of truckload volume come in there, but of course it's well serviced by 2 inland rail networks that push a bit of that freight inland. But we see a lot more truckload volume per, maybe 1,000 container moves on the East Coast versus the West Coast, just because of the fact that most of that intermodal volume, or about a third, but I think moves on that Chicago-Los Angeles lane, more economical to go by train, but truck on the East Coast is far more economical.
Correct. Yeah, the East Coast in general is more balanced than the West Coast, which is kind of accrues to indirectly to their advantage.
I'd love to learn a little bit more about the history of sort of containerization. You touched on it at the top of the show. I think that's a fascinating subject. Some of us listening to the show have read the box. You were sort of part of that era with Malcolm McLean. Can you talk a little bit more about that, Malcolm McLean, and what your involvement was at Trailer Bridge and sort of how that started the whole containerization movement?
Well, I was with Malcolm. He invented containerization in '56, which was right around the time I was born. So I certainly wasn't there then, but I was with him the last 20 years of his life. And in a book that I wrote, I referred to Malcolm when I was at U.S. Lines and McLean Industries. He did what I refer to as the second container revolution, and that was he built 12 ships called the Econ ships. And what that did was really kind of augment the clear process advantage of container shipping with the scale advantage of very large ships. And when he built the Econ ships, they were widely criticized by people. They said they were too big. They referred to them in one publication as Malcolm's canoes. But Malcolm had tasked his naval architect with building the biggest ship that could go through the Panama Canal. And they were something on the order of 4,400 TEU. And at that time, they were 30% larger than any container ship afloat. Race forward to today, and the largest container ships are 24,000 TEU. So they're about 6 times bigger. So what that has done, and those Malcolm's the larger ships proved to be significantly more economical, obviously per mile at sea. And so what that has done is really, I think economists have it a little wrong in terms of they don't appreciate as much as they should the effect of the cost efficiency of container shipping, with these large ships, driving down the transport cost to where in many cases, on average, it's only about 2%. So you can move something halfway around the world, for roughly 2%. And that is driven, obviously, a significant expansion in volume. And so containerization is cruelly changed the world. I happen to believe it's changed it in a better way. And there are people that will say, well, wait a minute, trade has disrupted economies, and it has. And I guess the advantages of containerization are quite clear. One could fault policymakers for not having those advantages flow more equitably. But I think the advantages worldwide are quite clear. In fact, Malcolm was recently recognized by a group called Human Progress. They named him as one of the 50 pioneers of progress, and it was people like Gutenberg, the printing press, and Jonas Salk. And Malcolm was the only businessman, along with Bill Gates, that they named a 50 heroes of progress. And they said that containerization really kind of put world trade into overdrive, and that brought, I think they said, 400 million people out of poverty. So the effect is pretty significant, and it's he was a brilliant man, and I enjoyed every day that I worked with him.
The container wasn't always 20 foot, 40 foot, 45, was it, on the international side? How did that start out with Malcolm?
Well, Malcolm came into containerization as a trucker. At the time, his McLean Trucking Company was one of the largest trucking companies, and he was moving quite a lot of freight from Texas and Florida to New York. And he just saw that as a more efficient way. Malcolm had always envisioned that the container would be the size of the largest van or trailer allowed in the U.S. At the time, that was 33. And when the U.S. went to 35 and 40, it kept on going up for reasons that probably have much more to do with the physical constraints in other markets. Container sizes kind of stopped at 40. But if you're looking at purely what makes sense for the U.S. market, obviously we've already determined that that's a 53. And that's why that I loop back into what I was saying, that perhaps there's a real need for a ocean service rotated around 53s. But yeah, the Malcolm, as an aside, Malcolm was well known to, even though the unit of measure is TEU for 20-foot container, Malcolm did not believe in 20-foot containers. Right. He saw them as highly inefficient. And if Malcolm was at any container yard in a company he owned, if he saw a 20-foot container, somebody would have hell to pay. He just didn't want that around.
Right. Hence the FEU term, the 40-foot equivalent unit.
Yes, yes.
Yeah. All right. This is fascinating. We could talk all day about this stuff.
Yes.
Ken, do you want to if we go to some other questions or shout outs? What do you think?
I think this is the quietest I've ever been on a podcast. I'm just sitting here absorbing and learning.
Yeah.
I don't see any questions in the chat or anything. You want to bring us home to some plugs?
Yeah. John, we'll have to get you back on. This is fascinating discussion to talk some more about imports. Maybe we can do that in the new year. But
I would love to do that.
Yeah, just some shout outs, just some things to keep in mind about what's coming up in the next week. Obviously, Sales Chat is on tomorrow at 11 a.m. with Dan Deegan. Landline Now, 7 p.m. on Sirius XM tomorrow night. I'll be on Road Dog Radio, Sirius XM channel 146 with Jimmy Mack this Thursday morning at 8 a.m. On the next issue of Freight Vine, the podcast, Chris Kaplis is talking to Jim Filter, EVP of Logistics and Transportation at Schneider, talking about the EV revolution and their adoption of electric vehicles within their California drayage operation. A really good show to listen to. On our next week's show, we have Lee Klaskow from Bloomberg Intelligence talking about his perspective on the current freight economy in the next 12 months. And with that, it's back to Ken to bring us home.
Yeah, we want to thank John for joining us. And maybe in the new year, we can kind of circle back around and maybe do kind of a whole chain, right? Going from import to dray to inland to final mile. That'd be kind of a cool concept to get into. So thank you for joining us. We got another busy week here in freight as we continue to inch closer. When we meet next week, it'll be spooky. It'll be the last day of October, right? Next Tuesday is Halloween, if I remember correctly. So we can all dress up like pumpkins. That would be terrific. But other than that, we hope everyone has a great week. We will see you back here next Tuesday at 10 a.m. Eastern. Thank you for joining us. Have a great week. Bye.
Bye, everyone.
Thank you.